Welcome back, everyone. This is Personal Finance for Us. I'm Claire, and today's video is going to be all about personal finance terms. 18 terms, in fact, you should know when it comes to money. Now, this by no means will be a comprehensive or exhaustive list, but it'll be a good foundation for us to build on. So without further ado, let's get into the 18 finance terms you should know. The first one is money. Now, I know this might sound silly, like, of course, we all know what money is, but I think it's kind of important to really understand money's basic role, right? So, once upon a time, people did what we called barter, right? So, let's say I am a chicken farmer, you are a corn farmer. I need corn to make feed, to feed my chickens, so I can trade for my chickens for other goods and services that I need. So, if you want chicken, I need corn, and exchange can happen. However, what if you don't want chicken, right? What if you're a vegan and you have absolutely no use for my chickens? In fact, you want to know where my farm is so you can emancipate my chickens. We don't have a deal, right? So I have chickens that I can't get rid of and corn that I can't get. So this is where money comes into play. Now we can go to a more general place that has everything, both the corn and the chicken. Individually, we buy what we need. So that is the purpose of money or currency. Assets. An asset is a useful or valuable thing, person, or quality. You as an employee, if you make your boss money, you're an asset to him. For our purposes, we're going to be talking about financial assets, things that you're going to hold on to like homes or stocks that hopefully will increase in value. Liabilities, also commonly known as debt. Liabilities are a financial obligation, payments going out the door. Interest. Interest is money charged for borrowing money. Anytime you borrow money, you got to pay for it. And it's typically charged as a percentage of the amount borrowed. So, for example, you want to buy a car, you don't have a car, the car costs $10,000, so you don't have the amount for the car, sorry. Car costs $10,000. You go to the bank, you get a loan, and the bank's going to give you that loan for $10,000 at 5% interest. So what that means is they're going to calculate 5% of that $10,000 annually and charge you a little bit of that each month. So in that first year, you're going to pay about $500 in interest. Mortgage. A mortgage is a loan against real estate. Principal is the amount you actually borrowed. So like in our previous example, the $10,000 for the car, that was the principal amount borrowed. Escrow. An escrow account is an account held by a third party on behalf of two parties in a transaction. The number one place common everyday people are going to see escrow accounts is within their mortgage. You always have to pay, of course, homeowners insurance, and you always have to pay your taxes. You can choose to pay those separately in one lump sum, or what most people choose to do, they just have it as part of their mortgage, roll it in. When you pay your mortgage payment, the mortgage company will take out that side of that portion of money and put it into an escrow account, and when the time comes, they'll pay those two bills for you. Amortization. Amortization is the spreading of payments over time. So what we have here is your standard amortization table that you usually see anytime you want to put in like a mortgage, check out a mortgage calculator. So this is an example of an amortization table of a $150,000 home financed over 30 years at a 4% interest rate. So as you see in the first year, 2020, you're going to pay a little over almost $1,600 in principal, almost $3,600 in interest, taxes, insurance, and fees, etc. And that goes all the way down for the entire 30 years until you reach zero. Investing. Investing is the acquisition of an asset for the purpose of generating income or appreciation. So it's something we're going to buy that hopefully is going to increase in value. Stocks, also known as equities, is the mini ownership of a company. Dividends are a portion of the profits paid out to shareholders. So I buy stock, the company makes money, is profitable, they split some of those profits, I get rewarded for buying their stock, I get a dividend. Mutual funds. Now, mutual funds, there's going to be a lot to unpack in these. Definitely worthy of at least one, if not two, of a video on their own. But for our purposes today, a mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. So basically, a mutual fund collects stock from multiple companies. You buy the mutual fund, your money is spread across multiple companies instead of all your money being with one company. Capital gains, the profit from the sale of an asset. A capital loss is the loss of money from the sale of an asset. Appreciation. Appreciation is the increase in an asset's value over time. Depreciation is the decrease in an asset's value over time. Aren't these terms the same? Not quite. All right. So I buy a house for $100,000. In 5 years' time, that house is now worth $150,000. The house has appreciated in value $50,000. I don't actually see a capital gain unless I sell the house. If I sell the house, now I've made a capital gain of $50,000. Same in reverse. If I buy a house for $100,000, it depreciates down to $50,000 and I sell it, I get a capital loss of $50,000. Bonds are definitely more stable. They're issued by governments and corporations when they want to raise money. When you buy a bond, you're basically acting as the lender. So when you buy a bond, you're basically buying debt. So let's say Tesla is offering bonds. You buy a $10,000 bond that's going to pay 6% interest. You get paid the interest while you wait, usually over the course of a couple times a year. And you will get your principal payment back on what's known as the maturity date. Most bonds tend to be 7 or 10-year bonds. So at the end of that period, whatever is agreed upon when you bought the bond, that's when you get your principal back. You don't actually get any stock. You're not an owner. You're just the lender. Net worth. Now, this is a big one. What your net worth is simply is your assets minus your liabilities. Now, we're going to be talking a lot about net worth because it's really, really important. It's an important thing to really wrap your mind around and understand. Because what your net worth does, it provides a financial health report. So let's look down at our examples at the bottom here. We've got Janet and Jane. So we'll start with Janet. Janet owns a home that's worth about $150,000. She owns a car that's worth about $15,000. She has a savings account that has $5,000 in it, and she has about $5,000 in stocks. So that means that her total asset value is $175,000. Jane's liabilities, on the other hand, meaning her debt, is she does still have a mortgage on the home for $50,000, and she's got a student loan hanging out for about $15,000. So her total liabilities, or total debt, is $65,000. $65,000 from the $175 means Janet has a net worth of about $110,000. Now, we'll switch over to Jane. Jane is a little lighter on the asset front. She doesn't own a home. She does own a car. It's also valued at $15,000. But Jane does have a savings account. In fact, she actually has more cash than Janet at $10,000. Jane, however, is a little heavier on the liability side than Janet. She has a loan on that car for $20,000, which is actually more than what the car is worth. This is such a common thing we're seeing in America these days. People will trade in cars every 2-3 years. As soon as you drive that car off the lot, you lose $2,000, $3,000, $5,000 in that first year. You go back and do that every 2 years, those losses start to compound. So she actually owes more than what the car is worth. She also has $5,000 of credit card debt hanging out, and she too has a student loan at $15,000. So Jane's total assets are about $25,000, but her total liabilities are about $40,000, which means Jane's net worth is actually negative $15,000. Why is this important? Well, let's say something major happens, right? Janet can offload or liquidate, maybe I should have had that term in this video as well, but she can liquidate her assets, right? So if she runs into trouble, she needs to sell her house, she could potentially get $100,000. She doesn't owe any money on her car, so if she sells her car, she can potentially get about $15,000. Whereas if you look at Jane, Jane's got nowhere to go, right? Jane sells that $15,000 car, she still owes another $5,000 in car loans. She can also use her savings account at $10,000, but that still doesn't even cover all of her student loan. So that's why this is such an important thing to understand. We always want to focus on grabbing onto those assets that will potentially make us money. We don't want to be too heavy on assets that lose money, and we certainly don't want to be too heavy in liabilities, because that just shows how much cash is going out of the door. All right, everyone, that concludes the video. This was 18 financial terms you should know. I hope this video helps, or it can at least be used as a reference for you in a later date. If there's a basic financial term that I forgot to mention, drop it down in the comments below. That'll do for me today, and I'll see you guys in the next video.